And then if we try to figure out what the elimination threshold on depreciation and payroll of a covered group is, it is quite simple. You multiply the covered group's revenues by 10%. So we get back to this, I think it's 8 billion or 9 billion. And you divide that by the product. You divide that product by the sum of the depreciation and payroll in Facebook. Now, the depreciation on property and equipment, I assume that you only do this on tangibles. If I remember, that's what the tax also say, is 6.4 billion. And it's a little more difficult to get to payroll because the Facebook accounts don't specify that. They do give us revenue, and then they give us costs and expenses, which include payroll and everything else, R&D, etc., etc. And I will simply assume that payroll is 30% of the total costs and expenses, which is quite general for companies to have around 30% of, sometimes 40% of their OPEX or of their turnover being personnel costs. So we'll take 17.5 million, and if we then apply this formula, we'll say that we take 8.5 billion and we'll take 6 billion plus 17 billion, which gives you 23 billion. And then we'll simply divide the 8.5 billion by the 23 billion, and then we will get to a elimination threshold return on depreciation and payroll for Facebook of 36%. So we've filled in one part of our formula. We now know that we should take the higher of the elimination threshold on depreciation and payroll, which is 36% or 40%. Now we should therefore take 40%, right? And then the next definition we need to look at is we need to look at the return on depreciation and payroll. And the return on depreciation and payroll is defined in Schedule J, and the Schedule J says the return on depreciation and payroll is the elimination profit divided by the total for the depreciation amount under paragraph 2 and the payroll under paragraph 6. Now, if we take Facebook Denmark's numbers, then employee benefits definitely is payroll. Depreciation on tangible assets definitely is part of the inclusion. And then the definitions also say, you know, if you rent something instead of owning it and depreciating it, then you should take that expense. I'm not sure whether you should take out the interest element in the lease cost, but we'll take the whole of that. I don't think donations, auditors' remuneration, or bad debt falls in this definition, nor does marketing costs. Maybe travel and accommodation, I'm not sure, but I took it out in any case. And then other administration expenses we will take out for the time being. What I don't quite know what to do with is professional fees, because the definition of payroll includes payments made to independent contractors. And the question is whether payments for professional fees, which I assume are either loan books that you hire as consultants, or it is your firm of accountants or lawyers and stuff like that, would be independent contractors. If it is, we need to add that as well. And then we come to a total payroll cost, if you want, of 34 million Danish kroner, which translates out to $4.5 million. So if we now calculate our return on depreciation and payroll for Facebook Denmark, it is the elimination profit, which is 3.3 million, the depreciation and payroll, which is 4.5 million, and then you divide A by B as I understand the text, and that gives us 74%. And I'm in doubt about this number, but I think it may also be correct, and I'll show you why I say that when we get to how we eliminate double tax. To me, there was nothing intuitive about this formula, but that is what it is. So let us move on, and we now come to our formula again. And again, as I say, this is an unreadable sentence. PEP is the portion of elimination of profit in Denmark, which would result in a return on depreciation and payroll in Denmark. So this is apparently the 74%. But which is equal to or higher than the elimination threshold on depreciation and payroll of Facebook Group, or 40%. So if we try to rewrite this, it says PEP is a portion of elimination profit of the covered group in Denmark for a period, yeah, which would result in a return on depreciation and payroll in Denmark equal to the higher of the elimination threshold return on depreciation of the covered group, or 40%. And then one last time, PEP is a portion of 3.3 million, which would result in a depreciation return, depreciation and payroll of the covered group in Denmark, which is the higher of 30%, 36% or 40%. But if we're going to choose between the 36% and the 40%, why did we just spend all this time calculating the 74% in Denmark? What do we do with that 74%? Apparently, we're only going to use that when we get to the elimination of double tax. But then why put it in here? I simply don't know, and I do not know how to read the text other than it is done here. So 40% of 3.3 million is 1.3 million. So the PEP is 1.3 million. So now we can try and plug in all the numbers into our formula and see where we get, but we do still miss something. Now, if I understand the formula correctly, and you'll see the text with me in a moment, the residual profit for Denmark technically would now be the 3.1 million, which is the elimination profit, minus this safe harbor, this PEP number, whatever that is, and then the residual profit would be 1.9, almost 2 million, which is a rather interesting conclusion considering our very first estimates of the real cost plus and the resale price for Facebook Denmark. But let's go through the calculation, because now we can apply the formula, the minimum of EP minus P multiplied by Y percentage, or the profit allocated to Denmark under 6.2, which was this 13 million, right? So we have the minimum of 3 minus 1.3, which is this 1.9 that we just saw, multiplied by Y%. Now, I don't know what Y% is. Y is the offset percentage, meaning the portion of the jurisdiction's residual profit, which is EP minus PEP. So that's what I just said, right? So you need to deduct EP minus PEP. So that is at 1.9 million. So it is Y is the offset percentage, meaning the portion of the 1.9 million that is eligible for offset under the MDSH mechanism. To me, this seems like a circular sentence, no matter how I interpret it, and I still don't know what Y is. I don't know whether I'm supposed to calculate Y, or whether because Y is in square brackets, this will be a percentage that will be filled in at some point. Considering the fact that the overall formula says that, you know, you take your residual profit and then you deem 25% of that to be a local marketing intangible, I will plug in 25% here for Y as well, and then our safe harbor will become the minimum of 1.9 million minus multiplied by 25%, or 11 million, and it therefore will become $497,000. That went a little quick in the transfer, but let us plug in all these numbers, because we now can say that the profit of the covered group allocated to Denmark is 11.4 million. We can deduct the MDSH deductment, which we just saw is $497,000, and then our adjusted profit before tax will then be 10.9 million, and the tax on that in Denmark, the tax rate is 22%, so that will give us 2.4 million in tax before we get to the double tax relief. So let us now see what we do with the double tax relief. And again, I'm going to go to the frequently asked questions, because it summarizes the text so much better than the law describes it. And in order not to make this video too long, I will simply not look at the law. I will look at the summary of the text and try to interpret this. Now, if we start with how you would calculate the double tax relief, my logic says you take the 10.9 million that we just looked at, you deduct from that the 3.3 million, which is already taxable in Denmark, and then you calculate the tax on 7.5 million, which is the difference. That is basic logic to me. The OECD method, so Denmark would have to give the double tax relief for the 7.5 we would be able to tax the 7.5 million and would simply not be able to tax the 3.3 million, and that would provide double tax relief in Denmark. But that is not the way the OECD logic works, because Pillar 1 logic, if we look at the text now, says the obligation to eliminate double tax would otherwise be suffered by an M&E with respect to amount A will be allocated among countries using a quantitative approach designed to ensure the obligation is borne by the countries in which the M&E earns its residual profits. Those countries will be divided into tiers based on the M&E's profitability. Okay, in each country relative to the overall profitability of the M&E. Now, we said the profitability of the M&E, the way I understand it, is this 36%, and in Denmark it was 74%, right? And double taxation would first be relieved by countries identified in the highest profit tiers. As such, double taxation is first eliminated by countries in Tier 1, those with the return on depreciation and payroll exceeding 15 times the overall M&E's RODP, using a waterfall approach, right? So let's just plug in some numbers here. Facebook's total income is 7.4 billion for Pillar 1. We assume that the profits already taxed locally for Facebook is 1.5 billion, for instance, through Facebook Denmark and other Facebook entities around the globe. Facebook's calculated RODP we looked at is 36%. Now, the Tier 1 countries, therefore, will be those who have 15 times more than 36%. So they would have a return on depreciation and payroll of 540%. So let's plug in some numbers here, but let's first look at the text here, because we need to use a waterfall approach, right? According to which the country with the highest RODP, which is a percentage, I believe, relieves double taxation on the amount of profit that would reduce its RODP until it is equal to the RODP of the country with the second highest RODP. And then you go on, these two countries then relieve a double tax on the amount of RODP until they are equal to the third country, etc., etc. This process continues until either the obligation to relieve double taxation with respect to amount A has been fully allocated, or RODP of countries in Tier 1 has been reduced to 15%. So you need to be to 1,500% of 3,600. So if you take 36% times 1,500% or 15, you get 540%. Now, what I don't understand about the waterfall approach is, in my logic, I would say, take the countries with the biggest nominal amounts of residual profit, but that's not what we do. We look at the highest percentage of RODP, because RODP is a percentage, right? So let's say we've got country A, B, and C. In country A, they only made 1,000 million, whatever, not 1,000 million, but let's say they made more than a million. In other words, they crossed the nexus threshold, and now country A made 1,000, country B made 1 million, and country C made 100 million. Now, I would think you start by giving a relief in country C, but that's not what you do, because the RODP for country A is 600%, country B is 580, and country C is 540. Remember, Facebook Denmark was 74%, so we're not way close to what we're going to get to, right? So the first relief will be from 600% down to 580%, meaning a relief of 20% of 1,000, which will give you 200, right? Now the remaining RODP for country A, B, and C is 585, 85, 50. So now country A and B needs to give 30% return, which means relief. So 30% of 1,000 is another 300 for country A in relief, and country B now gives 300,000, and then they all are on a return on depreciation and payroll of 550%. And they all need to come down to this 540%, so they all need to give another 10% relief, which means that the country A gives a relief for 100, country B for 100,000, and country C for 10 million. So the total relief now for country A is the 100 plus the 300 plus the 200, which is 600. For country B, it is 400,000. For country C, it is 10 million. So we've only given relief in Tier 1, in my example here, of 10.4 million. And I suspect that this will be the case in most countries, right? Because we are starting with the most profitable countries percentage-wise, right? And that probably will be a relatively small number of countries which will make 15 times more in the residual profit as calculated than the group does, right? So we then come to tier 2, which is a much larger group, right? To the extent that double tax is not relieved from tier 1, countries with even greater than 1.5 times the overall M&E's RODP would be required to relieve double taxation in proportion to their percentage of the total M&E's profit within that tier. Now there's nothing about a waterfall approach here, right? Until their obligation to relieve double tax with respect to amount A has been fully allocated within the all the profits in tier 2 are exhausted. Now again, nothing about waterfall. After that, the obligation to relieve double tax would be divided among all remaining countries. Now, so we're not going to get there. Now, 1.5 times means it is 150% of 36%, which is 54%. So Denmark would be in this group, right? Because Denmark had an RODP of 74% if we calculate it correctly, right? So now let's see what happens. Let's say we've got, I've not included Denmark in this calculation, but I want to show you what happens and what questions come up. So we've got depreciation and payroll for countries D, E, and F of 200 million, 300 million, and 400 million. Now, the first question that happened, and elimination profits of the same, the RODPs were simply 100% in every case, let's assume. So they need to give relief down to 54%, which means that they need to give relief for 46%. And Denmark would obviously have to give relief for 74 minus 54 is 20%, right? But now the question is, what happens to countries A, B, and C? Do they now also become tier 2 countries, and do we now reduce the double tax relief that they give or increase that even further, going down from 550% to 54% as well? So should tier 1 then also give another 500% of the 1,000? I'm not sure how that would work. But there is room for it, right? Because then you would have effective tax left in country A of 400 of the original 60,000, because that'll be 5,400 6,000 minus 5,400. But it doesn't say that. It seems like you completely leave tier 1 countries out, and now you start working with tier 2, and then 46% of 200 million is 92 million, 138 million, 184 million, and then your total tier 2 relief comes to 1.3 billion. Your total tier relief of tier 1 and tier 2 relief together is this 1.3 billion plus the 10 million, so it's 1.324 billion, and you still need to give a relief of 1.5 billion minus 1.324 billion, meaning 175 million, of which Denmark would also have to contribute its part. To me, this seems like an incredibly complex way to give double tax relief compared to the simple logic at the top of simply deducting the income that has been taxed already in the country from the allocated income. I'm sure there must be good reasons for this. I haven't looked through all the discussions in OECD as to why they deviated from a simple logical formula, but I'm leaving you with this. It has been quite a long session trying to dissect the text of the Pillar 1 guide law. I look forward to the guidance to see what I've done wrong or where I misunderstood the text. There's still a lot of other things, but we're not going to look at that, such as how do you deal with segmented companies, how do you deal with flow-through companies, how do you deal with loss carry-forwards, and all those things. Those is not covered for this quote-unquote high-level review of the Pillar 1 legislation. Next time we will look at case law again. Bye for now.